A decade ago, the world witnessed a significant drop in oil prices, setting off a chain of economic ripples that continue to resonate today. Recent observations suggest that this historical event may hold clues to the trajectory of the stock market in the present year. Welcome to Stock Whispers, your gateway to investment brilliance. Today, we will delve into the intriguing connection between the oil price drop a decade ago and the potential implications it could have on the stock market's performance in the current year. Let's rewind the clock back about 10 years to a crucial moment in the history of the oil industry. Between June 2014 and January 2016, something significant happened. The price of crude oil dropped dramatically, sending shock waves throughout the global economy. This drop was like a domino effect triggered by the United States ramping up its fracking activities, which is a method of extracting oil from deep within the earth. This sudden surge in U.S. oil production flooded the market with an abundance of crude oil, causing prices to plummet. Now, let's talk about OPEC, which is a group of countries known for producing a lot of oil. They tried to deal with the situation by cutting back on how much oil they were pumping out. Their hope was that by producing less oil, they could keep prices from falling too much. However, despite their efforts, the market remained oversupplied and oil prices continued to drop. Eventually, by the summer of the same year, OPEC realized their attempts weren't working and they decided to stop trying to control the situation. This decision led to even lower oil prices. While this meant cheaper gas for consumers at the pump, it also brought significant economic challenges for oil producing countries and industries worldwide. So, those days of filling up your tank for less were a direct result of the ups and downs in the oil industry during this time. Here's a fascinating discovery from Tom McClellan, the insightful mind behind the McClellan Market Report, which has been providing valuable insights into the stock market for years. McClellan has uncovered something truly remarkable: a striking correlation between movements in crude oil prices and subsequent movements in stock prices about a decade later. It's as if there's a hidden rhythm in the financial world, with the echoes of one market resonating in another years down the line. What's particularly intriguing is that this pattern isn't a recent phenomenon. It stretches back all the way to 1896, when the Dow Jones Industrial Average, one of the most prominent stock market indices, was first established. However, what adds an extra layer of intrigue to McClellan's discovery is the fact that despite his keen observation of this pattern, he's unable to provide a concrete explanation for why it occurs. It's a puzzle that has puzzled financial analysts and researchers alike. Yet, despite the lack of a clear-cut explanation, the consistency of this phenomenon over such a long period is undeniable. This discovery opens up a realm of possibilities for investors and analysts, offering a potential roadmap to understand and even predict future market movements. By recognizing and leveraging those long term correlations, investors may gain a valuable edge in navigating the complexities of the financial markets. So, while the exact mechanism behind this phenomenon remains elusive, its implications are undoubtedly significant, making it a topic worthy of attention and further exploration in the financial world. Before diving into predictions based on this pattern, McClellan offers a word of caution. While there's a noticeable 10-year lag between oil and stock market movements, it's not always a precise timetable. Sometimes the stock market can be ahead of or behind schedule by a few months, adding a layer of unpredictability to the equation. Additionally, it's important to note that the magnitude of fluctuations in oil prices doesn't always align perfectly with changes in stock prices. In essence, this correlation provides insight into when certain events might occur rather than the magnitude of their impact. So, while observing this trend can offer valuable clues about future market movements, it's crucial to approach predictions with a level of flexibility and understanding. Investors should be mindful that while historical data can provide guidance, it's just one piece of the puzzle when navigating the complexities of the financial markets. By acknowledging these nuances, investors can make more informed decisions, mitigating risks and maximizing opportunities in their investment endeavors. And let's not forget, life is full of surprises, as evidenced by the unforeseen events like the COVID-19 pandemic that struck in March 2020. No oil chart or market production could have anticipated such a monumental disruption. However, in the aftermath of the pandemic, there was a noticeable scramble in the stock market to align with the movements in oil prices, highlighting the interconnectedness of these economic factors. Similarly, looking back at historical events like the Gulf War in the early 1990s, we see a deviation from the expected pattern. While oil prices experienced a sharp spike followed by a decline, stock prices did not mirror this behavior, showcasing the unpredictability of market dynamics. These examples serve as reminders that while historical trends and correlations can offer valuable insights into market behavior, they do not always dictate future outcomes with absolute certainty. External factors and unforeseen events can disrupt established patterns, leading to unexpected fluctuations in both oil and stock prices. Therefore, while it's beneficial to analyze historical data and trends, it's equally important for investors to remain adaptable and prepared to navigate the uncertainties of the ever changing economic landscape. By staying informed and agile, investors can better position themselves to capitalize on opportunities and mitigate risks in the dynamic world of finance. Despite the uncertainties, McClellan is placing his bets on a challenging period for the stock market from June 2024 to January 2026. This forecast isn't just about numbers. It could also spell a rough patch for whoever takes office after the 2024 election. The implication of market trends could extend beyond financial charts to influence broader political and economic landscapes. But amidst the gloomy outlook, there's a glimmer of hope. McClellan's predictive model suggests a bullish market phase between 2026 and 2028, offering a ray of optimism for investors and policymakers alike. This anticipated shift could signal a period of potential growth and prosperity following the challenges predicted in the preceding years. For the time being, the U.S. benchmark West Texas Intermediate crude oil remains relatively stable, maintaining a narrow trading range. If historical patterns continue to hold true, this stability in oil prices could translate to a period of calm in the stock market around 2034. However, as with any forecast, only time will tell how events unfold, leaving the story of future market dynamics to be unraveled on another day. So, what's the bottom line? It's essential to pay attention to historical trends, but remember to take them with a pinch of salt. While past patterns can offer valuable insights into potential market movements, they're not set in stone. History serves as a guide rather than a guarantee of future outcomes. Therefore, it's crucial for investors to remain vigilant, adapt to changing circumstances, and make informed decisions based on a holistic understanding of market dynamics. Thanks for tuning in to Stock Whispers. If you enjoyed this video, give us a thumbs up, subscribe, and hit that notification bell so you never miss out on our expert investing advice. Until next time, keep listening to those whispers and let them guide you to your next big win. See you soon.